Can the S&P 500 really beat most investors at their own game? Let us put this legendary index to the test and see if it truly holds the secret to long-term investing success. Investing in the S&P 500 is often seen as one of the most reliable and straightforward ways to build long-term wealth. It's a favorite among beginners and experienced investors alike, and for good reason. The S&P 500 represents the performance of the 500 largest publicly traded companies in the US, offering a level of diversification that's tough to match on your own. This broad exposure helps reduce risk while increasing your chances for steady, long-term growth. Many investors prefer the S&P 500 because it's simple to invest in and has a strong track record of returns. Unlike actively managed funds that try to beat the market, the S&P 500 takes a passive approach by mirroring overall market performance. This usually means lower management fees, which can make a big difference over time. The appeal of investing in the S&P 500 lies in its set-it-and-forget-its nature. You choose your investment, stay consistent, and let time do the work. But does this strategy truly outperform most investors? Let's dig deeper into that question. There's an ongoing debate between active and passive investing. Active investors aim to beat the market by selecting individual stocks or funds, while passive investors stick with options like the S&P 500. Many assume active investing delivers better results, but research consistently shows that that's not usually true. In reality, a large number of active investors end up trailing the market average. High management fees, constant trading, and the challenge of picking winners all play a role. In contrast, investing in the S&P 500 provides broad exposure to the market with much lower costs. Another myth is that you must be a financial expert to succeed at investing. While knowledge helps, even professional fund managers often struggle to beat the market consistently. For most people, a disciplined strategy like investing in the S&P 500 can be both effective and stress-free. Some assume that investing in the S&P 500 limits you to large-cap companies. However, the index spans multiple sectors and industries, creating a balanced and resilient portfolio. It's not just about big names, it's about capturing the strength of the entire market. The S&P 500 has a long record of delivering consistent returns over time. Since its inception, it's averaged roughly 10% annual growth. This dependable performance is one reason it remains a go-to investment. Historically, it has even outperformed many actively managed funds. Most individual investors earn less than the S&P 500's average returns, often because they buy or sell at the wrong times. Panic selling during downturns or overbuying during rallies can seriously hurt long-term results. Investor behavior, timing, and fees all influence outcomes. Those who chase performance or exit during downturns usually see weaker returns. The S&P 500 encourages patience through a buy-and-hold mindset, which tends to yield better results. Emotions like fear and greed are major obstacles to success. Many investors make rash decisions in volatile markets. Investing in the S&P 500 helps remove emotion from the equation and promotes a steady, long-term focus. Compounding is another powerful advantage. By reinvesting dividends and staying invested for years, S&P 500 investors can see exponential portfolio growth. It's a simple yet powerful wealth-building mechanism. Fees can quietly drain returns, especially in actively managed funds. The S&P 500's low expense ratios help investors keep more of their earnings, which adds up significantly over decades. Take, for example, an investor who started putting money into the S&P 500 20 years ago and reinvested dividends consistently. Over time, that investor likely outperformed most active traders simply by staying invested and letting the market work. The real takeaway is that investing in the S&P 500 isn't just about tracking the market yet. It's about harnessing its full potential for long-term growth. By minimizing costs and maximizing time in the market, you give your money the best chance to grow. If that same investor had put $10,000 into the S&P 500 2 decades ago, they'd have a sizable portfolio today, assuming dividends were reinvested and the investment was left untouched. This shows how a disciplined, long-term approach often beats active trading. The S&P 500's strong historical performance makes a compelling case for its effectiveness. While it won't always be the top performer every year, its consistency and cost efficiency make it a solid option for long-term investors. In summary, the S&P 500 remains one of the most practical ways to build wealth steadily. It provides broad diversification, low fees, and the power of compounding, all essential ingredients for long-term success. Trying to consistently outperform the S&P 500 can be difficult. High fees, emotional decisions, and bad timing often work against investors. That's why many end up underperforming despite their best efforts. By choosing the S&P 500, you're essentially betting on the strength and stability of the US economy. You're investing in the biggest, most influential companies that continue to shape global markets. If you're re-evaluating your investment approach, the S&P 500 is a great place to start. Its simplicity, proven record, and passive strategy make it an ideal foundation for most portfolios. Before you invest, take time to think about your goals. Do you want a low-maintenance, long-term plan, or are you comfortable taking bigger risks for the chance of higher rewards? I'd love to know your thoughts about investing in the S&P 500. Have you tried it, or are you planning to start? Share your experience in the comments below. And if you want to keep learning, don't miss our next video on dollar cost averaging, where we break down how consistent investing can build serious wealth over time.